Price pressures appear to be building in the UK, and that's having an impact on the Bank of England's interest rate pathway. Well, this week is going to be absolutely key. We've already seen the PMI data coming out on Monday. Tuesday, we've got the jobs report, all eyes on the average earnings figure. Wednesday, we've got CPI, and then, of course, the Bank of England on Thursday. So let's dive into exactly how these events could feed into that Bank of England decision and where we're going to see the pound and the FTSE 100 go. So let's jump into it. I've got a host of things to show you as ever. First and foremost, we have the breakdown in terms of the numbers. Now, like I said, I'm recording this in the wake of that PMI release. So essentially, I haven't got that on the breakdown here, but what I can say is exactly how it has come out. And essentially what we've seen is the composite number has remained steady at 50.5, but beneath that, we've seen weakness in terms of manufacturing, which dropped from 48. So it's already significantly below that 50 threshold. It went from 48 to 47.3. And on the flip side, services improved further, 51.4 up from 50.8. We saw a worse than expected manufacturing figure. We saw a better than expected services figure. And crucially within that, we saw a number of different things, and I'll show you that on the next slide, but let's just pick through some of the other stuff that we're going to be seeing in the coming days. So first and foremost, on Tuesday, we've got the jobs report. What stands out within that? Well, it's that average earnings figure, 4.3 up to 4.7. When it comes to the figure excluding bonuses, that's expected to rise also from 4.8 to 5%. So the health of the jobs market is key, but also those price pressures, those wage pressures are going to be absolutely key. So there's a strong chance, as markets are pricing, that we see a bit of a jolt in market sentiment because of the fact that it appears that inflationary pressures are resurfacing. Well, how does the inflation report feed into that? To try and fit it into this page, I've stripped out the likes of the retail price index and the PPI. But really, we're all going to be focusing on these CPI figures anyway. And so what's going on? Well, headline inflation expected to remain at 2.3%. Core expected to rise, already at a troublesome 3.3%, but there's an expectation it's going to rise further to 3.4%. Notably, we can see that there's an expectation that both figures on a monthly basis come in at minus 0.2. And that does highlight the idea that the month of November on a sort of cyclical basis generally is a month where we see significant weakness in terms of price pressures, in part because, you know, if we're seeing negative 0.2 expected, and that feeds into an expectation of higher inflation, higher core inflation, that means that essentially we're stripping out an even bigger negative number from a year earlier. And then we look in terms of Thursday's Bank of England rate decision. The expectation here is that we see them holding off this time around, pausing at 4.75. So let's get back to the PMI story. Here's that divergence, as you can see here, with manufacturing output declining further and services business activity on the rise, but that comes off the back of a sort of pullback recently. So it's not to say that we're seeing super lofty figures in terms of the services numbers. In terms of the breakdown, here's some of the key snippets that I've taken from that report, which highlight a couple of things, right? The weaker economy side of things on the left, right? So we're talking about growth headwinds, fragile consumer confidence, tight budgets, cutbacks on non-essential spending, decline in new work across private sector activity, steep and accelerated decrease in new orders in manufacturing, destocking on the manufacturing side, weaker demand from European clients, fastest reduction in overall export sales since October 2023. Also, we've seen weakness in terms of the jobs numbers. So fall in total staffing numbers for the third month in a row. The rate of job shedding across the private sector economy was the fastest for almost 4 years. Particularly steep decline in employment in the service side of things, mainly linked to non-replacement of voluntary leavers in response to rising employment costs. They did note the imposition of some of these policies under the Labour government, and certainly they didn't hold back on that front, really. That they said that a lot of the weakness was down to the new policies brought about by Keir Starmer et al. So we've got a weaker economy. That would make you think that the Bank of England are going to act. But the flip side of it, stronger inflation pressures, rising salary payments, elevated domestic inflationary pressures, pushing up cost burdens across the private sector in December. The rate of input price inflation accelerated for the second month running to its strongest since April. Manufacturers recorded the steepest rise in purchasing prices since January 2023. So that's like 2 years ago, right? So anecdotal evidence cited rising transport costs, raw material prices, pass-through of higher employment costs by suppliers, average prices charged by private sector firms increased at the steepest pace for 9 months, led by a robust and accelerated rise in the services economy. So look, what we're seeing here is that there's weakness within some of these sectors, in particular that, we're talking about service providers recorded a particularly steep decline in employment at the end of 2024. So we're even seeing some weakness in the services sector. But really, it's the price pressures that keep pushing upwards. And so this is kind of a worst case scenario, right? A weakening economy and stronger inflation. You'd usually think, and certainly when we see higher interest rates, you'd think, okay, well, higher interest rates may worsen the economy, the economic outlook, but it drives down inflation. Right now, we're seeing weakness in terms of many aspects of the economy at the same time as surging underlying price pressures. And this idea that we're seeing a resurgence in terms of inflation pressures really underpins the fact that the Bank of England is expected to cut rates at a slower pace than, say, the ECB. In terms of the breakdown for how the jobs report on Tuesday is going to impact things, well, of course, we have that association between average hourly earnings or average weekly earnings, excuse me, and then inflation. So we've got it here. I've got 4 lines on, right? So we've got the weekly earnings excluding bonuses, including bonuses. And as I said, we're expecting to see both of those markedly increase. So 4.3 to 4.7, so 0.4% rise and a 0.2% rise in the excluding bonuses. That's what's expected, right? And you look at the relationship between wages and inflation, because ultimately it's all just, price pressures that then get pushed onto businesses and they have to up their prices. So you can see here that excluding bonuses, yellow, and the red line, which is the including bonuses, both have been tracking very closely to, in particular, the services PMI number. And so bear in mind that the services inflation is the main problem. It's not necessarily goods. Goods has been, for the most part, negative for a lot of this year. The services sector inflation has been the big problem. And you can see it here at 5.02%. You can see that services inflation is one of the key components that drives up the likes of CPI and core CPI. And so if we do see that uptick in terms of weekly earnings on Tuesday, it feeds into the narrative that Wednesday is going to see a rebound in terms of inflation pressures as well. Excuse me. So let's look at inflation. So like I said, there's this expectation that we're going to see a minus 0.2 figure for the headline CPI. And you can see that the figure being replaced from last year is also a negative number. That's why we're sort of netting out as seeing pretty much expectation of no movement, right? But here's the concern. Look at the last month's figure, the October number, 0.6%. Now, looking aside from that, we had that one sort of stronger figure of 0.319, which was in August. But we had been on a really good trajectory. June, July, September, all really good figures. And that pointed towards the idea that by the middle of next year, all of those big figures from February, March, April, May will all strip out. And therefore, the UK will be in a really good position in terms of inflation. That last monthly figure of 0.6 starts to tell a different story. And that's why this report this week in terms of inflation is going to be absolutely key as we try to determine whether that was just a one-time blip. And certainly if we do see a minus 0.2 figure, then, people would think, okay, you net that out and, we're in a decent place. But netting between the two of those does put you on track to start moving back towards 2%. But, when we're looking at, say, the PMI numbers, that points towards price pressures. And so possibly we could come in higher. And certainly if we did come in higher, then that would put further pressure on the Bank of England. In terms of The figures for the core number 3.3, there's an expectation that moves higher. You can see that we have had a couple of decent size prints, 0.427, 0.439 over the past few months, and you can see in terms of the 3-month annualized, which is the purple line at the bottom, that's sort of 3.5% alongside the past 6 months annualized as well. So we are continuing to track above target in terms of those monthly figures, even by the middle of next year, so in 6 months time. So if you look at the figure that's dropping out last time around, well, it's the November figure. So like I said, it's a negative figure. So we're expecting to see something similar this time around. But as things stand, we really need to know whether the figures from August and October are outliers or whether that is indicative of resurgent price pressures that could be highlighted by, number one, the PMI report, which we've already heard from, and number two, the jobs report, as if we see a surge in terms of wage figures, which is what is expected this time around. So certainly if we see a stronger than expected inflation figure off the back of a strong wage rebound, off the back of a surge in terms of services price pressures in particular, it's like every single day is telling us that inflation is coming in higher, and that leads into a Bank of England rate decision where people have to make their mind up as exactly how they see things playing out. And certainly you can see in terms of the trajectory of rates for the Bank of England, which is the dark green line at the sort of top, we're looking at a central bank that has been taking it very slowly. You can see 2 rate cuts thus far in the cycle, and well over and above many of these central banks, in particular the likes of the ECB, and we'll look at that. But certainly the Federal Reserve is another central bank that we're sort of looking at and thinking they could take it relatively slowly as well, because they've got a strong economy and possibility of a reflation move. The difference is that the UK, those PMI figures don't necessarily signal that the UK is in like super strong position right now. So the Bank of England starts to then get into a position where they're weighing up sort of worsening economic picture potentially against a resurgence in terms of price pressures. Thankfully, the composite PMI still does remain in expansion territory, but certainly quite anemic growth being pointed to there. In terms of the expectations for the Bank of England rate decision, you can see here no change expected at 84%, 16% chance of a rate cut. And then further out, you can see essentially a 65% chance of a rate cut in February. And then beyond that, you're looking at May. So we're essentially pointing towards the possibility that we cut rates every quarter. And that kind of lines up with the Federal Reserve, right? So, is that how it's going to play out? We don't necessarily know. And certainly the possibility of a reflation move is going to be absolutely key to that. Now, if we look at the comparative yields between the UK and the Eurozone and then chart it against Euro Sterling, we can see here the weakness in terms of the Eurozone 10-year yield compared to the UK highlights how that shift in terms of expectations for rates across these 2 different regions has provided downside for the pair. Now, off the back of the PMI numbers, we have seen the pair rolling over once again. And so let's just quickly jump onto the chart and see exactly how things are looking for Euro Sterling. I am aware of the fact that this is a chart that I already highlighted on the week ahead. But nonetheless, I said I was going to provide a more detailed breakdown. And this is it. And I thought I'd still raise it because I think it's a really interesting one, certainly being such key neighbors and trading partners. But also we're seeing this divergence in terms of price pressures where the UK is a little bit more at risk of a rebound in terms of inflation, and UK core inflation remains well above where it needs to be, whereas the Eurozone certainly is a better position to keep inflation depressed. And so markets are expecting a rate cut pretty much every time around from the ECB. So we were talking about the possibility that this recent rebound was going to be short-lived. Now, this rebound came off the back of a GDP number from the UK that came in at minus 0.1. There was an expectation it was going to come in positive territory. It didn't. So people started thinking, well, okay, if the UK is in a position where it's posting negative growth figures, then the Bank of England is going to have to act. So we saw some weakness in terms of the pound, and so strength in terms of euro sterling. Well, we're starting to see that unwind because ultimately, if inflationary pressures are coming back into play, then a minus 0.1 GDP figure isn't, in my mind, suddenly going to turn heads at the Bank of England. And certainly the PMIs have already pointed towards resurgent price pressures. We've got expectations that the wage figures do the same. And then it leads into an inflation report, which, yes, there's an expectation we come in at minus 0.2, but maybe that's a low bar of which that we might end up coming in at higher than that. Certainly if you look at the data coming from the likes of the jobs report and the PMI surveys. So that points towards this trend potentially continuing in line with that chart that I just showed you, right? With this chart where we've got the deterioration of euro 10-year yields versus the UK 10-year yields. So back to euro sterling, and we can see here it's rallied up into the 76.4 Fibonacci level. It hasn't tagged it, but it's come very close to it and starting to weaken here. So we're starting to see a little bit of strength coming in here, but I think there's a good chance whether this is the top or whether we come back up into trendline resistance. I think there's a good chance that this zone is an area where we're going to see it rolling over. And certainly if we do see strong numbers in terms of the PMIs, like I said, but also the wage figures, the CPI numbers, that all feeds into that narrative as we head into a Bank of England decision where, are the Bank of England in a position to start saying that they're anything other than data dependent, and the data is heading in the wrong direction when it comes to inflation, that points towards that once every quarter rate cut, sort of 100 basis point per year outlook being potentially correct. So there's a possibility we've topped out here. Maybe we rebound and then we roll over again, I think. But essentially, unless we see the 83649 swing high taken out, which would also necessitate the break through this trend line, then for me, I think there's a good chance that we do see the bears coming back into place soon enough. Now, taking this from a similar approach and looking at it in terms of the US, you can see here that we've got the 10-year yield for the US and the UK versus cable, and you can see a similar kind of relationship. It sort of broke down a little bit. You can see back in sort of October odd times where we saw that weakness in terms of cable, but we saw the rebound in terms of the treasury yields. Well, it appears to be the case that it's kind of back on track at the moment. The difficulty here is that we have a number of different things going on here, and both the Federal Reserve and the Bank of England are both in a position where they could potentially be cutting rates every quarter, and so you're looking for relative shifts between the two. Are we going to see something this week that points towards the relative dovishness from the Bank of England? I don't necessarily think that will be the case. So, where do we stand in terms of this pattern? Well, we've seen a sort of strengthening coming into play here, and if we sort of bring up the chart for cable, you can say, okay, we've seen this rebound, but it is set within this sort of trend. So you can see consolidation phases, and this does look a little bit like a sort of retracement phase set within a bearish trend that has been dominating since October. If we go further out on the weekly time frame, though, you can say, okay, we've got this sort of ascending trend here as well, though. So, are we still trading within this bullish trend here? Quite possibly, right? So I would say that if we're looking for bearish positions for cable, you'd want to see a move back down through the near-term swing low 125, which would also necessitate a breakdown through trendline support. But certainly key to that is if you want to break this long-term bullish trend here for cable, then 122992 is the key swing low to follow. Just quickly going to grab a Fibonacci and see exactly where we stand on the fib perspective. You can see we've come into the 76.4 fib, run past it, but now starting to see some strength. In terms of the 4-hour chart, are we coming into a retracement here? Let's see. So potential 61.8. There you go. So perfectly on the 61.8, seeing a bit of strength at the moment. So there's kind of arguments on both sides, but I do think there is an argument that we could see a bit of a rebound. And certainly if we come in for some strength here in terms of the UK inflationary pressures, say that CPI numbers or wage numbers, things like that, then it does provide the basis for a potential rebound. But it's difficult because you're trading against something in terms of the US dollar that has really been very strong of late. Now, just to wrap things up, always worthwhile taking a look at the FTSE 100. Now, first and foremost, I wanted to overlay it with the FTSE 100 against the S&P 500. I could do it against the Dow. I could do it against the NASDAQ. The story is going to be the same, right? It's underperformance for UK stocks compared to the US. So what that means in my mind is if you're looking for long positions in equities generally, indices and equity markets, generally I'd be looking towards the US if I'm looking for long positions. If I'm looking for potential short positions, then the FTSE 100 could be an interesting one. And certainly if we're coming in a week where they reiterate the data dependency and that data is all coming out as being troublesome, then I think that we look kind of at risk here, quite frankly. And you can see here in terms of the latest rally, we've got this sort of zone of resistance. I'm sure we have a little trend line on the top of it as well. So there you go. So we're at an area where you've got these long upper wicks, upper shadows. And so you're seeing rejection at these levels. And now we're starting to roll over. So I think there's a good chance that we do see this index weaken in towards the back end of the year. Of course, people are going to be crying, what about the Santa rally? Well, maybe the Santa rally doesn't necessarily extend to the FTSE, right? And that might be a way of covering it is, to be long US indices and short UK indices. But certainly if we were looking for a market to be long right now, I probably wouldn't be looking at the FTSE 100. Instead, if we start breaking down through levels like, well, going the wrong form, there you go, 8248, 8237, that then completes that head and shoulders formation and points towards potential for further downside following this rally into this area of resistance, be it trendline resistance, horizontal resistance. We've not been going anywhere for the last half a year, essentially. And given the way that the data is going at the moment, I don't necessarily think that we're in a position where suddenly we're going to break out from this. So this market, in my mind, is at risk of rolling over once again, if only to stay within this sort of range. Let's look in terms of momentum. You can see, already have seen significant downside movement within this. Let's see in terms of the weekly time frame. So sort of bearish cross after a rally towards that overbought territory on the weekly. So I think there's a good chance that we do see a bit of weakness. And certainly, of course, it's going to come down to the data. But the data as things stand doesn't appear to be lining up perfectly. Let's look out for how it plays out, in particular that CPI report. If we see that minus 0.2 figure on both core and headline, then that's good, but that lifts things in terms of the annualized metrics. But if we see that coming in stronger and stronger wage pressures and stronger price pressures, as noted in the PMI report, that doesn't necessarily bode well for a Bank of England decision that they're going to feel confident to start laying out a clear pathway lower for UK interest rates that's going to be any faster than, say, once every quarter, which is currently what markets are pricing. So a really busy week. Hope this has been useful for you guys. It's a massive week anyway, quite frankly. We've got the likes of the Federal Reserve as well, which with the core PCE price index. I'm going to make a video for that, and the Bank of Japan as well. So I'll make a video for that. So a busy one as we wrap up what is a historic year for financial markets, and there's still plenty left in the tank in terms of volatility. So make sure to like, subscribe, follow, and we'll be providing plenty more content as we roll in towards the new year.